Five-Star Business is the next company which is on our radar. Fourth quarter was strong. Loan growth is robust. Business momentum was strong, while asset quality was also under control. Mr. Lakshmipathy Deenadayalan is Chairman and Managing Director at Five-Star Business. So good morning. Great to have you with us here as we do every quarter. Let's just start by, why don't you sort of characterize what the business environment was like? Because, two companies now that we've spoken with have kind of called out a little bit of weakness overall in demand. We had a cement company early on. We had a company which is Castrol calling out a little bit of softness in consumer demand. Now, of course, different industries. You are very much focused on the very small business loan segment, and you kind of said that this is the segment which gets affected the last in any kind of upheaval or slowdown, etc. So just start there, sir. What was the environment like, and call out the rest of the year for us, FY25.
Yeah, thank you for this, Prashant. Let me again reiterate what Five-Star is. We are not a general vehicle loan lender. We are lending to a niche segment where the formal finance people would have not lent or would have lent lesser. So that is the niche that Five-Star is catering today. The small business shopkeepers and self-employed of this country, they are predominantly depend upon the local money lenders for any credit needs for their housing or business needs. That's where Five-Star steps in, and we move these customers from informal to formal. So I don't see any kind of weakness both in loan growth and as well as from the collections perspective. The outlook is very strong. Post-COVID, especially post-COVID, we have been giving a growth of above 30%. The same growth of above 30% will continue.
All right. Good morning, sir, and good to see you in. Nigel on this side. So that 30% growth, if you can split it up for us, I think your rough ticket is around 3.5 lakh approximately. Will there be any increase in the ticket size? Will it be volume driven? If you could give us some clarity on the 30% growth. And also the cost of funds. How is it impacting you? What's the guidance on the NIMs? Because you were changing your borrowing mix as well. Please go ahead.
Yeah, that's a good point. I wanted to clarify on the cost of funds and the mix that what Five-Star is today looking at. If you notice our presentation, we have given a very strong indication that one domestic financial institution and one foreign financial institutions have invested in our debt, both close to one 450 crores, another 500 crores. So this gives a very, very strong signal that even though the liquidity is getting tighter, people lending to the segment indirectly through Five-Star is picking up very strongly. And our cost of borrowing on the book is sliding down. We were at 9.7%. It is at 9.7% for the full year. And our incremental cost of borrowing also, it's at the same level of 9.7%. This is from the liability side. From the average ticket size, we intend to stay on with the same profile of customers. And our ticket size was, even pre-COVID, our ticket size was around 3.5 lakhs. We tend to stay at 3.5 lakhs. And maybe we will moderate upside, keeping the inflation in mind.
Okay. So going by you're saying on the cost of borrowings as well as the changing, NIM should hold in that vicinity of around 17.1%. Is that correct? Or is there an upside risk out there?
No. Please see Five-Star not as a general NBFC because we are a bit overcapitalized. We have been guiding very clearly to the market that our NIMs today is at 17% plus. That's not going to be sustainable. The NIMs will see moderate slowdown because we keep borrowing more from the market for our above 30% growth. So the NIMs at the steady state, maybe 2 years, 3 years down the line, will be around 15-16%.
Got it.
15 to 16%. Okay. So speaking of capital, our colleague Abhishek points out that while, of course, the growth has been absolutely phenomenal, you've also been consuming a lot of capital. So the CRAR, that ratio has come down from the highs of the mid-70s a couple of years ago to, I think in this quarter, it's down to about 50.5%. So is there a certain level that you're comfortable with? Would you look to shore this up again, or are you comfortable at 50%?
No, I think there are two things which is happening hand in hand. One is the growth is very strong. As you keep borrowing, your capital has to come down. That's been coming down steadily. During our IPO, we were at less than a one-time leverage. Today, our leverage is at 2.25 times. So that shows how our strong leverage is picking up, and that will be shown on return on equity, which is touching 18% for this quarter, and for the full year, it is around 17.6%. So that's quite impressive. That comes from your lowering your capital and you're borrowing from the market. Second is on the recent circulars of RBI, keeping the end use into account, they have raised the capital adequacy for the certain end users. Five-Star's end use goes towards business, housing, and some personal needs of our customers. For the personal needs, we have raised our capital adequacy from 100 to 125%. That's where the capital is dropping down from 50 to around 52%.
Okay, we'll leave it there, Mr. Deendayal. Thanks very much for joining us. Good to speak with you. And just one last point. Return on equity, I think when we've spoken last, you'd given a slightly longer range guidance that you said would be about 20%, right? That still holds?
Yeah. In next 3 years, we'll be at 20% plus. That holds very solid.
All right. Thank you very much, sir. Good speaking with you. Appreciate it. That's Five-Star Business, and 30% growth like clockwork is what they're saying they'd be able to do. And, demand, etc., remains very buoyant. Generally, a pretty solid set of numbers.